Hello, this is the chart profit video, 2 hours into the trading day on Friday the 5th of August. This from the pre-open today. Said here as long as the E-mini holds a major point of control, that's the major point of control support at 2087, is in a strong price location longer term. In the shorter term, we've seen the 2-month point of control recently migrate to 2160.5, which is here, currently printing above that level in a strong price location. This is a live chart hourly. E-mini S&P September contract. Down here is 2087. That's the major support, and here's the 2-month. This level here, 2160. Following jobs data pre-open, market came higher. A few weeks ago in Friday video, gave a target of 2175 for the E-mini, and we reached that here. As the market came off pretty quickly from that level, below what was the minor point of control at 2160, I thought that aggressive or significant selling marked below that level would be quite a negative development if I saw that actually. And here we are again back at the target level at 2175. But I think the fact that the minor point of control, or the 2-month, has migrated to this 2160 level after this long period of oscillation here, upsets the minor distribution a little bit and potentially gives us a higher target above 2200. As I said, pre-open, significant buying marked above this level, 2160, would be a really positive development. We'll have to see if that is marked either today or in the coming week. Caveat being, if the market finds itself printing back below 2160.5 down here early next week, we're back in a short-term weaker price location. But as long as we hold that level, very strong. When we look on the auction chart here, this just shows the profiles day to day, but over a long period of time. We can see that back here, Friday the 8th of July was the last time I marked significant buying. We came pretty quickly higher and then went into this range. Did mark significant selling here, but as I said at the time, it was completely ineffective. The value area was very much overlapping. Suggested at the time that might be just buyers resting, waiting to gauge a reaction from the sellers. It was pretty muted and ineffective, no follow through. Just interesting, we've seen across this range just a real lack of directional conviction, so no green or red marked here as this 2-month at 2060.5 emerged. As far as the breadth indicators go, this is the New York chart, breadth indicators through Thursday. You can see here that here's the range that we've just looked at. This is on the S&P itself. But across that range, we've seen the breadth indicators giving us a clear negative divergence here, but we haven't seen any kind of weakness that you might expect from that playing out. There was a similar pattern back here in March as the market went higher. These two indicators diverged negatively. This black moving average on the net new highs 25 indicator got back to 0 at this point, and the net volume percent 10-day moving average got back to 0 sort of here. Saw the market rally from there. We're about at this position now. So we're seeing just a non-confirmation of price from these indicators. So if the S&P does push higher, we're not seeing currently this sort of confirmation from these indicators. But most importantly, I rely on price and the profile, and we've yet to see any markable selling activity, which in any time frame or in any way you could call effective. So for me, that would be the first sign of weakness, and we haven't seen it yet. And in the slightly longer time frame, as long as this indicator here holds above 0, and this indicator here, the percentage of stocks greater than their 50-day moving average on my New York list, if that indicator holds above 50, we keep this green bar here going on the breadth indicator on the pulse chart. Again, you can see the divergence with the price momentum heading down, flattening of price here. But again, in the longer time frame, if this is green and this is green, i.e. above 0, this is a supportive pulse chart. We'll look at the sentiment indicators, the RIDEX, my version of the RIDEX assets ratio. I have it just sneaking above 6 here on Thursday, which is a 6-month high. And as we've said over the last few weeks, though this indicator has been pushing higher over time, it's still really very muted, down around 6, which used to be a high level, but when we compare it to the 14 back here in March 2015, or even this price here, or this level here around 8 or 9 before the sell-off early this year, this is actually still a low level. Nevertheless, a 6-month high in optimism for the RIDEX traders is worth noting. If you ask me to produce a list of negatives for the market right now, that would be one of them, 6-month high on the Ridex. Looking at the bull fund assets, Ridex bull fund assets in isolation, you can see here moving higher, have not yet exceeded this level. But again, looking back over time, this is not an elevated level. Just zooming in there, you can see the bull fund assets reached this level back in April. Should they exceed that, I would mark that in a negative sense. That might give a little more negative expectation if we did see that first sign of selling on the profile. And at the same time, you can see that the bear fund assets on their own here, close to the lowest level that we've seen this year. So the Ridex traders, the optimism creeping higher here. This is the public poll from AAII. This week the bulls percent was slightly lower at 29.8. The bears percent, that was also lower at 26.8. If we look at the bulls minus the bears, the net, and we run a 4-week moving average of that, which is the black line here, you can see that last week's or the previous week's reading for this sentiment indicator that I follow actually exceeded the high in April and was the highest since this point back in November. Considering the S&P's been breaking out to new highs up here, that does look like, again, a fairly muted, tepid level of optimism. But again, it is about 8-9 month high. Investors' intelligence, the bulls percent this week was lower at 52.9. That was actually down from 54.4 2 weeks ago, which was the highest bulls percentage since May last year. That 4-week moving average, the black line here of the net, bulls minus bears, at 30.7 this week. That's the highest since July last year, back over here. And the exposure index here, which measures current equity exposure of active money managers, that was down this week at 93.05, but a week ago it was above 100, 101.02, and that was the highest reading since November 2013. So there's definitely bulls emerging in this data. Couldn't look at it and say it was screamingly euphoric and therefore a negative for the market, but there has definitely been a pickup in bullish sentiment over the last few weeks. US indices relatively outperforming all the other major global indices that I follow. Here's the Dow, the diamonds, DIA, IWM, the Russell 2000 ETF overcame its resistance, this major at 115.35 in early July, and is now at a new high for this move. The Qs representing Nasdaq 100, technology heavy, pushing out to a new high here. You can see on the chart that we tested this proven support, which was the major at 105.13, just for a day or two. That was immediately rejected like pushing a ball underwater and just sprang back. One of the key charts we were following was the FTSE 100, the UK FTSE 100 future. This is a September contract, and we were watching 65.25, a major point of control, which gave us a bit of resistance at this point. Looks like we've now had a higher low above that level, pushing out to a new high for this move right now. If I zoom out, you can see it's been relatively underperforming the US relative to last year's high and low. Retraced over 75% of that decline now, and as I say, at the end of this week pushing out to a new high for this move. Here's the Brexit spike. Here's the German Dax Index, an underperformer, but looking at the moment as though it will attempt a test of that April high. Again, if I zoom back, we can look at the relative performance, which is lackluster relative to that high last year, and this low yet to retrace half of that decline, which comes in here, a little higher. This is the T-bond ETF, TLT. We've been following the halfway point off the June high, which comes in here, just to give us a guide to short-term strength weakness. We just turned back down on that off that level just yesterday on Thursday. Price back up here would put the chart in a really strong position again. Been responding pretty well on the positive side when the oscillators turn up. Until that happens and price gets back above here, I'd consider TLT in a reasonably weak position in the short term. GLD, the gold ETF, in a very strong position longer term, as long as it holds above 118.22, which is the major point of control. I think dollar's a bit higher today. Gold has come off a bit. Oscillators have just turned down. Again, has been responding pretty well to the oscillators turning up. Just the technical momentum measures. That's a good indication. Usually that trend is up when the buy signals work a lot better than the sell signals. And longer term, as I mentioned, GLD, gold, still in a really strong position. Been talking about USO in the pre-open day to day. Oil was the big focus back here on the big decline. Had a very close correlation to the S&P at that point. Doesn't seem to be anywhere near as much of a focus in the media on this. I mean, it has retraced more than half of the rally off the February low. This actually looks like a weak chart. We're below the 9-month, which is up here, and below the halfway off the low. I would consider this a weak chart. I definitely want to see USO back up above here, minimum. I've also been following the Crude Futures. This is the September contract, so from the February low to the high at this point here. Here's the halfway, and we seem to be holding that level pretty nicely at the moment. So I'm watching this for a further sign of weakness on this futures chart. Price down here below 39, would be a big negative for oil and most likely risk on assets in general. And we'll finish with a look at the currencies. This is the dollar index itself. We've been watching the 2-year point of control at 95.25 for a while. We probed it, but that support, which is quite important support, has held quite nicely here. And just today we're having a decent rally and attempting to print back above the halfway point of this high to this low. So price printing time above that level, which comes in around 96.30, would be a bullish indication, further bullish indication for the dollar, further sign of strength, almost like a mirror image of that. And we're looking here at the Euro FX chart, and again printing almost exactly at its halfway point from last year's low to last year's high, which is the current range. Price back under here, just a little lower, puts it in a weak price location. We follow this day to day in the chart profit pre-open. Finally, I want to finish on the British pound, and this is an hourly chart. I'll zoom in a second, but just to show you the major levels, 132.28 up here is the minor point of control on an hourly basis, since the chart is clearly below that level, and the halfway point from the low to the high on any time frame, an important level to follow, comes in here. And the pound on this hourly chart here relative to those levels in a really weak position. It's quite possible, if there is a little rally here, that this point of control 132.28 could actually migrate lower. That would be interesting. But this chart currently at the end of this week definitely in a weak position. Okay, that concludes this week's video. Once again, I wish you a good weekend and thank you for watching.